All right. Hello, everybody, and welcome to Benchmark International's webinar series. Today, we're going to be talking about what the sell-side process looks like for both sides of the table, as a sell-side advisor and as a buyer. So I'll be your host for this webinar. My name is Jordan Houtz, and from the middle market, investment banking managing director here at Benchmark. And a little bit about Benchmark. So we've been in business now 18 years. We've done $14.2 billion of transaction value across, over 900 total transactions at this point. We have offices in 9 countries around the world, speak 36 languages, and truly enjoy serving our clients in the lower middle market. A little bit more about me. So I'm based here in Tampa, and as the managing director of the middle market team, we focus on transactions that are $50 to $500 million in total enterprise value across primarily 5 industries. That's industrials, business services, consumer, healthcare, and technology. And so I lead the team, and we're focused on driving maximum value for each of our clients. So let's set some expectations, do a little housekeeping around the webinar today. Everything that we offer here is not legal advice, financial advice, tax advice, or otherwise a recommendation for you and your business. What we're talking about today is trying to help business owners understand how to prepare for a transaction, conceptually what that means, how to maintain strong market readiness, meaning not only have you done the work to prepare, but now how do you stay prepared to launch? And then lastly, what does an M&A process look like overall? So we'll cover that across 5 different topics. The first being how buyers assess businesses, right? Putting on the hat, the lens of a buyer. What do they look for? Why? Next, we'll talk about what drives a premium valuation. So yes, price typically is the number one and most important thing in business owners' mind, and we want to address that. Third is, uncovering what the value gaps are. A lot of times there's some blind spots that business owners don't see, and we want to unearth those before we go to market. Number 4, we're going to build an exit readiness plan. This will look different for every single seller, right? Every single business is different and unique. If the steps are largely the same. So we'll walk through those. And then lastly, we'll talk about how to position your business with the right buyers. So walk with me now on this path, right? We're going to put on the buyer hat here and think for a minute about how buyers assess the businesses that they look to invest in. So when we do this as a sell-side advisor, we're trying to put ourselves inside the mind of the investing professional across the table. That could be someone at a private equity firm. It could be someone at a family office. It could be someone at a strategic, which is basically editors here on a client, or someone in the industry that wants to vertically or horizontally integrate. Or it could be what are known as an independent sponsor or fundless sponsor, someone who is an operator with not secure or semi-secure funding. And each of these buyer groups are going to look at your business differently, right? And I'm going to go through this webinar talking as if I'm talking to the business owners, because that's who we primarily work with. So the buyer mindset when an opportunity reaches their desk is actually they probably already have a thesis around where your business fits within their investing paradigm. And the way that they do that is they do a lot of market research before your name or your company's name hits their desk. And they have shaped a view and opinion on the industry. And they're now trying to figure out how your business fits that paradigm and what they're going to use in terms of information or data that they collect from the market or business to determine what competitive advantages you have. Are they sustainable? And is your business a premier asset to purchase within a given space? Some of the factors that buyers will prioritize, obviously revenue and EBITDA are going to be pretty important from a financial perspective. But those are just 2 data points. They want to look at trends. They want to see, is revenue growing? Is it flat or is it declining? They want to see margin. Is it growing? Is it compressing? What are the factors or forces that are driving that? Financially, they care deeply about gross margins. That's pretty consistent across all the industries and clients that we have. And gross margin on a per employee basis, on a per client basis, and certainly how does that all translate to free cash flow generation? I think beyond the financial metrics, they are keying on things like hiring rates, churn, um, growth by customer, and obviously this depends on which industry that you're in, but they care deeply about turnover, not only of your employees but of your customers. And lastly, I would say they care deeply about how your business makes money. Like, what is the operating cycle of your business? How tech forward are you? How integrated are your systems, processes, and people? And so, not only are the financials sort of the result of all of that work, but they're not the only story. How buyers weigh risk against opportunity. So, if you're a buyer, um, you are constantly thinking about the risk return trade off. And through a diligence process, they're looking at your business to unearth and discover what those risks are as early as possible, because if those risks are large enough, then they'll kill the deal. And the faster they can kill your deal, the better, because they want to get to the very best deals that survive their risk profiling. Strategics, and kind of mentioned this earlier, but strategics, private equity, family office, and independent sponsors will all look at your business differently. If you're a strategic, a lot of that is synergies analysis, both revenue and cost, trying to figure out how accretive, any one acquisition is to the business, how complementary the customer bases are, the product sets, the geographies, service lines, all of those things. And when a strategic buys a particular company, they care deeply about the integration plan, how that looks across systems, people, technologies, processes, regulations, geographies, languages. It can be extremely complex. And so strategics, as a result, largely move slower than family offices or private equity or independent sponsors. Private equity groups can have a bad rap. Obviously, there have been many experiences where private equity has bought businesses and destroyed them. I think for the most part, that's not in their interest to destroy businesses that they buy, because they have to hit certain hurdle returns. And what does that mean? It means that they have to hit a certain level of performance across all the businesses that they buy. And so there's never really an intention to hurt, harm, or otherwise scuttle a business, but more so to grow it. Now, the challenge is sometimes those private equity firms are not operators. They are not the strategics that you might have at the table who really deeply understand the business. They're looking at it more through the financial lens and relying on other people, other professionals to run the organization. Family offices are a hybrid, right? They're usually really smart money. They're people who have built businesses themselves, most likely sold them, and then made hundreds of millions of dollars and put that to work in a single or multi-family office setting, whereby they hire truly intelligent investors to put that capital to work on their behalf. And independent sponsors are a new or newer or emerging group of investors who probably are operators and who are looking for funding to go acquire and then run a business. And so they often come in with the highest and most unsophisticated bids at the beginning, and don't really offer clarity around closing. They can present a lot of problems through processes that we run. But they are frequent or more frequent bidders in some of the processes that we've seen. Lastly, common misconceptions owners hold about the value of their own business. This is a big one, right? There's going to be a valuation gap or difference between what an owner thinks that their business is worth versus what a professional investor thinks it's worth. And there's a lot of sometimes nostalgia and sentimentality around that, and that's okay. But we have to understand that any investor needs to rationalize the performance of the business down to financials, metrics, and performance, and not necessarily how many years, blood, sweat, tears it took to make the business. So what do buyers look for in practice, right? There's certain characteristics that attract buyers. Obviously there's financial profiles, there's customer profiles, there's technology, there's geographies. There's a lot of things that make a business attractive. And certainly as markets shift, regulations shift, technology advances, and, you know, life in general becomes more competitive, our clients, need to keep that in mind, right? They need to be mindful about how are they going to maintain a sustainable competitive advantage in an increasingly competitive marketplace where people are getting smarter because of advanced technologies like AI, or they're being more careful with their dollar because of inflation, or because there's more cybersecurity threats, whatever the case may be. But the enduring characteristics of valuable businesses typically are that they're growing, that they're not just growing, but also scaling operations. And we'll get to that a little bit later. They're profitable. They understand their value proposition and stick to it. They have a strong culture, and they have an asset base and performance that, underpins all of the things that are, part and parcel to their business. Um, we talked a little bit about how these buyers view, how different buyers view the businesses that they look at. Um, Strategics typically take a very long hold as do family offices, whereas independent sponsors and private equity investors have to sell their business within 3 to 5, sometimes 8 years, because their business model dictates through a fund structure that they have to return capital to their LPs. So they're inclined to grow as fast as possible, almost to the point of breaking the business because they have to maximize their return over a specific time frame. Whereas strategic, investors and family offices, that may not be the case, just given how their business is going. So what can I share in terms of lessons learned on both sides of the table? As a side note, I've worked in private equity across a few different industries for over 5 years. Most notably, of course, WT Private Investments, where I was a buy side senior principal, where we invested in Main Street businesses through AI and machine learning, which at the time was pretty novel. This is pre-open AI, but I think buyers are forming an opinion about your business before you're even really a target. They're doing their own market research, trying to figure out who is in market, what leadership positions do they have, what are the characteristics of those leaders, and they begin their benchmark analysis to say, okay, should any particular opportunity hit their desk, how does their informed view of perspective on the world match that of their target company? And can that target company become a true leader in the space? And if not the leader, which is usually sort of like the platform or something similar, then how can this potential opportunity become like a bolt-on or an add-on acquisition to further accelerate the pieces that they already have? You as a business owner will most likely not change the mind of the investor, especially around their thesis, but more so either fit it or not fit it. And they're going to be very judicious with that, dispositional. So how do we drive premium valuation, right? Everyone wants to know, how do I get the most money and maximize the value of my business through an M&A process? And should I do it myself versus use an intermediary? That's a very common question that comes up, and we're going to get into that. So you should be thinking as a business owner about designing your entire business for exit. If you're not already thinking that, then if at the point at which you ultimately do want to, then it's going to be much harder to prepare to sell at that point than if you've been designing along the way for exit. There are some key things that we mentioned here about, how to prepare your business for a premium. Ultimately, it comes down to people, product or service, and process. Professionalizing everything, making sure that you have great visibility and reporting into everything, and not just being able to report on it, but actually having high quality people driving it. If you as a business owner are too involved in your business, that can actually be a weakness. And so you probably need to learn how to delegate. You need to bring other people into the picture who can help drive certain functions or roles within the business, and thereby give you leverage and ultimately provide value to you because you're not the key person risk, no longer to the organization. So we say here, like revenue quality versus quantity, absolute dollars are important. Trends and growth are more important because you're signaling to a buyer that over time your business will grow and become worth more money. Some of the other ones here, like the recurring and predictability of that revenue is critical, especially in the technology sectors that we cover. Some of the other, services businesses, like being able to really truly predict that revenue in a recurring nature if possible makes you more valuable because it's more durable and it's less likely to churn and more likely to be, underwritten at a higher level. Customer diversification continues to be a big deal. Many of our clients come to us with exceptionally high concentration risk. And this is a challenge because, acquirers will need to underwrite that risk and think critically about, if any one particular customer were to churn out of the business, how much potential revenue and margin goes with it. And so, having a very diverse customer base, a diverse vendor base, so both revenue and cost are diversified in a way that any systemic shock won't completely disrupt the business. Scaling operations and growth opportunities are very significant. Most of the buyers that we talk to, that's some of the first questions out of their mouths are, what does the next 1 to 3 years look like for the business? How is the business prepared to scale in the near term? Who are they hiring and what is the skill sets of the people that they're hiring? And they're going to look at a lot of financial and operational metrics there to determine if the business is truly scaling, right? So revenue to expenses across a lot of different varieties, revenue per employee. You're going to look at the gross margin per employee. And then that drives all the way down to each product and service the business offers and whether or not it's profitable. Obviously, you might have some loss leading products and services, but or be magnet type products and services, but ultimately, like, your business has to be very profitable. And if margins are compressing, cost is an issue, and you have to plug those gaps quickly. Last note on here: quality of earnings matters. So, and we're going to talk about this more, but if you're designing your business for premium valuation, having a sell side quality of earnings value really helps you get clarity around, EBITDA, EBITDA add backs, net working capital, and any other, potential movements or seasonality that hits the business. And by having those numbers in place today, you're doing more to prepare your business for negotiations than you would otherwise. So in some ways, the quality of earnings report acts as sort of a floor and a basis around which the negotiation happens. It certainly doesn't create the ceiling for you in those terms of talking with buyers. So additionally, just a few other things to mention here. Companies that have achieved premium valuations really are those that they have excellent leaders. They have instrumented their business so they really understand the unit economics of their performance. And they're companies that are prepared to scale and grow, right? Doesn't matter what industry it is, what product or service they offer. If there is not growth in the picture, it's much harder for investors to pay a premium. They just have no incentive to. Um, you know, we look quite closely across all of our transactions at what drives those premium valuations, and those are the things it comes down to. I think in some cases with the sell side quality of earnings, especially as the business gets larger, we need to signal as the advisor, the buyer needs to see a signal from the seller, true quality to those earnings, meaning they have audits, they have reviewed financials. If neither of those, they have a quality of earnings that is sort of pressure tested the last 24 to 36 months worth of financial data. And there's good controls, there's good performance, there's good margin. They have clarity around add backs because, excuse me, most often the basis for transactions is EBITDA. And so, unless you're a tech company, perhaps, and then it's revenue, but for the most part, it's some measure of financial profitability, be it EBITDA, be it, NOPAT or something similar. And really the way you get that clarity is by having a third party validate it. Now, the cost on this can be, $30K to $100K for a quality branch report. It takes 4 to 8 weeks to get done. We don't recommend it for every client, but certainly the larger clients that we have buyers asking us quite quickly, all right, is there any kind of audit, review financials, or even narrower scoped quality of earnings report that we can rely on to have certainty around those numbers? And that's coming from the buyer, right? Now, a buyer, some may argue, well, the buyer's going to do it anyway, and that's true. But if you establish the basis for that negotiation, you have greater leverage, and the buyer is there burdened with determining proof that those are not the correct add backs versus beating you up in negotiations over what they think are the right add backs, and thereby reducing EBITDA and therefore reducing home price value to your company. So, what are the gaps, right? As we go through this as advisors, we see this quite quickly, what the value gaps are. Some business owners hopefully can take a pause and think to themselves, what are those gaps, right? What are the gaps in my management team? What are the gaps in my revenue operations? What are the gaps in my service? What are the gaps in my product development? These are critical things to be thinking about now, because if you don't, a buyer will certainly uncover them either sooner or later in their diligence process, and most likely discount your organization because of it. And so what does that mean? It means that you've got to think critically about all the different components of your business and what could potentially show as risk versus certainty. Because every buyer in their mind is typically very risk averse. They're going to spend millions and millions of dollars to acquire your organization. And the more risky that becomes, the less money they're willing to spend. So that's operational, legal, financial, tax, commercial. There's all kinds of risk. And the more that you can reduce that risk and thereby increase certainty, the more likely you are to have a smoother diligence process and ultimately a stronger and more competitive M&A process. So what are some of the hidden issues that can delay or derail a transaction? There could be outstanding tax liabilities, like unfunded pensions. It could be things like, lawsuits that are outstanding, pending or threatened. It could be other things that, culturally, potentially within the organization are not, homogenous to whatever the buyer thinks the culture should be. It could be a myriad of things, but whatever those are, you have to take inventory. This is where you have to be really honest with yourself about how much you are invested into this business. And sometimes the risks actually look like positives to you, but they might not be to a buyer. And we're happy to get into those with you at some point. If you're curious, you can call us and we'll talk through those things. So how do you prepare versus what is discovered, and how does that shift price? So if there are bigger risks that are not identified early, what happens is in the back end of the end of the process, and you're going through all of this very, very deep, invasive, diligence, and something comes up, it can derail the deal. It can kill a deal very quickly. And that's the worst case scenario. Now, something less than that is usually a retreat, where the buyer, writes down their offer, or materially changes the structure of the deal such that they shift more risk back to the seller. We see that from time to time, where buyers will change the nature and type of a deal from a stock deal to an asset deal to try and carve out certain liabilities that they don't want to mess with. They will opt to create some sort of new co-acquisition structure whereby they can transfer risk from existing entities to new entities to carve that out and identify and protect themselves. There's all kinds of mechanisms that come into play. All of those, the more complex the deal becomes, the more likely a retreat is, and the longer it takes to get a deal done. So we find that by having clients be very prepared, financially, operationally, yeah, etc., that we can create the marketing materials faster, get into get into the market process itself faster, answer buyer questions better and more confidently, and ultimately move smoother through the most challenging part, which is closing diligence towards the end of the transaction. And so, how a business prepares today um, really does matter for the process that they want to run and the value that they want to capture from an investor in the marketplace. So, um, I think those are all key takeaways from that section. Um, so, what does it look like then to build an exit readiness plan? Like, at, at first glance, it might seem really overwhelming, actually. Trying to think through, well, gosh, I got to clean up my entire business and change all my operations. The short answer is no, you don't. You need to start small and you need to work with the things that drive the most value first. And usually that's your financials. So you need to think about having very, very crisp, clean financial reporting for at minimum the last 3 years. And that needs to be shown on a monthly basis. It needs to be fully baked. You need to know everything about your EBITDA add backs, and you need to have like GL level evidence for every add back. You can test the rationale and defensibility of every add back with, your tax or quality of earnings provider. Their CPAs are going to be able to walk you through different treatment for every single add back and its defensibility within, and scrutiny out of the buyer. I think the other thing that we have often seen people who succeed the most through an M&A process do is they have a cohort of people within the organization that understand the objectives of the owner through the process. Is it strictly to recapitalize the business? Is it a management buyout? Are they just taking on growth capital, which we don't do? We're 100% sell-side advisor, but it is still an option. Or is it 100% exit or majority exit of this business, and why? And so by having a cohort of, usually the senior team or key people on the senior team knowing what's coming, the diligence request that we ask for information through or the buyer's ask will actually go smoother because there's a team now instead of only like one or two people within the organization who know what's happening. And it also controls the narrative around, and reduces the panic risk within the organization that people just don't know what's happening. So by having 2, 3, 4, 5 people who can retrieve the information that we need and understand the objective of the exercise will make the process much, much smoother. I think that also extends to, different compensation provisions for that. For certain people who may within the organization get deal bonus by helping with deal close or stay and help build their organization through transition. And positioning those key employees to benefit through employment agreements and other, sort of arrangements with the potential buyers so that they can continue on the organization if they so choose. I think and some of the other things that need to happen, like in your plan, is you need to actually put to work whatever growth initiatives you're considering. If you have a list of them, but you haven't started them, you will get no credit for them. I mean, the buyer will see that as like their own shopping list of things they're going to do to create value versus the things you've already started, thought through, pondered, and elected to pursue that are already generating value. So you want that premium, pick your highest and best growth initiatives and get to work doing it. And what you'll find is that you probably should have started that earlier and taken on that sort of, risk to some extent. Because if you don't, you won't get any value for it. Okay. What does this look like over time? So once you've actually done the work to get it, it's kind of like physical activity. Once you've done the work to get in shape, it's a lot easier to stay in shape than it is otherwise. And so what does that mean? It means that you have the right people in the right seats of the organization heading in the right direction at the right time. That's really what it means. And that all flows and pushes through systems and processes and technology that exists within the organization such that, every person knows their responsibilities, does them well. And if there are problems in their ranks, like those need to get solved. And that way you're sort of ready, right? One of the things that we tell our clients is with achieving the maximum valuation is we're trying to prepare or marry, you know, market performance with company performance. And so often those are not synced up. um, if you're an organization that isn't performing well, but the market is doing well, then you're probably not a leader in that market, and that's going to be a challenge for you to achieve a clear evaluation. If you're doing really well and the market is growing, that's a positive signal. If you're doing really well and the market is sort of either flat, partially declining, that's also a signal that like you're probably about to do. So readiness over time is really about aligning all your internal operations and uh, growth initiatives with the right timing of the market. Some sellers, some of our clients will tell us like, "Oh, I'm doing my very very best this year, and I want to sell the absolute peak." And a little bit counterintuitively, like that's actually not the best time to sell because uh, buyers will look at that and say like, "Oh, that's a high watermark. Like, why should I pay top dollar today if, you know, this is the best it's ever been?" And you actually want to sell on your way up. So they'll be able to show growth beyond where you're at today so that they can go capture that value tomorrow. All right. So when we position you as a business in the market, what we're trying to do is drive competitive tension. So through an open market auction, broad market auction process, what we do is bring way more than one party to the table. Sometimes business owners believe that like, oh, I've got a pocket deal or I can just negotiate by myself with one or two people who I know really well and they'll give me the best deal. They're usually dead wrong. And they don't know that, sadly. We have seen so many people get absolutely raked over the coals because they just didn't trust a broad market process. There's confidentiality concerns. There's uh, all sorts of other issues. They don't want to take too long. They want a faster deal. They believe that whoever they're talking to is going to give them the best price. Like something that every seller needs to understand is the buyer is not their friend. They are not there to give them the best deal. They're not there to give them the best terms. And they are definitely not there to give them the best price. And so by hiring an intermediary like us, our job is to literally create a market to sell your business. And to do so in a way where we go and we canvas the market for who we think are the very best, most likely, and most capable buyers for your business, such that through a controlled, confidential, and professional process, we can actually raise bids. And I've seen this happen many times because the best buyers get in the same process and they learn that they're one of three or five or eight. And now they have a real shot at buying this business. If we start at the very beginning through, understanding the buyer landscape properly, we're not wasting our time on people who aren't truly interested, either because of their thesis or, maybe they're digesting a previous investment or they just don't have capital, whatever the case may be. We're avoiding those situations because that just increases operational drag and slows down the process. Whereas what we do is we think very critically up front about about our client's business, who they are today, why are they the way they are, how are they winning, how are they sustainable in their performance, and how will they win tomorrow. And by positioning that business appropriately, we feel and find the very best buyers for that business across the four different buyer categories that we talked about, and both domestically and internationally. Right. So our buyer book is well over 400,000 buyers, and that's been a benefit of being in business for 18 years and doing nearly 1,000 deals. And that scales truly from individual investors with a lot of money all the way up to fully professional investors that are backed by billion-dollar funds. So we believe very strongly that we have strong buyer intelligence. And not only do we know the buyers, but we know how they behave. And that's a true mark of having high quality advisors, understanding how those buyers will perform through a process. So it's not just about telling a compelling growth story that a buyer can validate or saying that you have some sort of differentiating technology. It's actually about having exceptional market positioning and the right buyers at the table. So again, more on competitive tension, but excuse me, the point being is that by having the right buyers at the table, not only is it excellent from price discovery and structure discovery standpoint, where it gives our clients the ability to choose the highest and best bidders and the best fit for them. But what it also does is it tells us how to negotiate on their behalf and to be able to incrementally add value towards the final, hours of the deal. I have actually seen deals, jump in price the very last hours of deals, 5, 10, $15 million, just because the buyer ultimately understood what they had to do to win the deal. And by uncovering their real need there, whatever it may be, growth, expansion, got to hit an earnings target, something else. We uncover those needs for those buyers and position the asset for maximum valuation. So how does all this apply to an M&A process, right? We're kind of nearing the end of the conversation today, but what I want to do is focus on, how does this all matter now that we've talked about preparing the business for sale, how buyers view the business and so forth. And really it all fundamentally happens before, or most of it should happen before you get into an M&A process. If it doesn't, it's going to happen somewhere between steps 1 and 3 on our roadmap. So step 1, you meet an advisor like us. We prepare those materials, the buyers list, and everything else, and we go to market. We want to make sure that we have captured as much understanding, knowledge, information, and value about your business and how to position it before we go to market. And sometimes that means that, our clients will engage with us. And for several months, it's, cleaning up the financials. It's maybe I've seen companies rebrand, right? And go through a rebrand. I've seen new websites get built or built. I've seen people get hired. I've seen people get fired. All these different things just to get ready to go to market. And we don't want to unnecessarily recommend any course of action that's going to, take some long time, but you really do need to think about these different components that we've talked about today and several others to be ready to go to market. Once that process happens in stage 3, we're in market with your business, usually 1 to 2 to 3 months tops. We can stay on as long as we need to find the right buyer, but to really drive a competitive process, you want to go out to the appropriate set really quickly and gauge their interest and then drive that competitive tension into negotiating offers. Once we get, an initial indication of interest and we figure out who are the top 10 to 15 buyers, we're going to put half of those through a management presentation where the buyer actually gets to meet the seller or client for the first time. And those are in-person meetings. They last a few hours. And then once that happens, we ask for best and final offers through an LOI so that our client can pick who they think is the very best buyer. Then we go into diligence, which can take, 1 to 2 months. Typically it's 60 to 90 days. I think we've been seeing diligence times creep even farther if our clients are not ready. So commercial diligence, business diligence, financial, tax, legal, compliance, all these different types of diligence. If most of that work is done at the beginning or before we start, then everything in the end is confirmatory. And so that increases your certainty of close. That de-risks the situation for the buyer and creates a situation where you're less likely to be retraded. And ultimately, more deals get done because of that. So today, there are some key takeaways, right? You need to think about how your business is prepared for sale. Think about customer concentration. Think about key person risk. Think about, vendor risk. Think about churn. Think about revenue continuity and durability. Get into the weeds in your own business. Make sure it's instrumented. Make sure you have the right people in the right seats heading in the right direction. If you have gaps in your management team, now's the time to fill 'em, because as a business owner, you need to extract yourself from your business enough where you can prove that it can run without you. Because if it cannot run without you, that's not a business, that's a job. And those don't sell very well, certainly not for a premium. Consider running a sell side quality earnings process, right? Not only have you potentially gone to an auditor or reviewed financial situation, but now you have a third party independent of your auditor or your tax accountant who looks at the business and says, okay, here I can validate and prove cash and I can prove revenue. All my rev ops are verified. I can look at your margin profile and determine what EBITDA actually is, because it doesn't show up on your financial reports. It has to be created. You can validate and authenticate all EBITDA add backs, and you get a net working capital calculation. So you really understand how that affects transaction value at the end. It's worthwhile. It is 30 to, 100K, but that's an add back during your process anyway. So you get that third party stamp of approval. It's just the floor and basis for valuation. And it gives buyers a lot of confidence knowing that like your books and ops are in line. Then it's really about getting more and better clients and shoring up your business. And then lastly, thinking about yourselves, right? As the business owner, who would I want to sell this business to and why? Who do I think is the best buyer? But having that done through an intermediary like us is so advantageous because you don't have to focus on this. That's our job. Like you get to focus on running your business, growing and scaling versus, having to run all the diligence or negotiate by yourself, which is really challenging. Because often if you're negotiating by yourself, in many ways you're negotiating against yourself. And so exits really rarely happen by accident. They need to be planned. They need to be thought through. And if you have any questions about this, like we're happy to hop on a call and talk to it. Right. Like that's the job that we love to fill. We love to serve our clients in this way. And I've loved to do it over the last 15 years. So if you have any questions, call me and we'll talk about it. But, in the meantime, like I'm really glad we were able to spend some time together today. Thank you for that. And look forward to hearing from it. Thanks.